Right, here we are, Cleveland Cash Flows, indirect method, preparing the statement of cash flows. So this is a series of videos that are going to walk through the indirect method. You have a file, it has this worksheet, looks just like this one, except that I've copied this set of formulas down. So this has the balance sheet, comparative balance sheet at the top. And then below, there's a place that's statement of cash flows where we fill in the statement of cash flows. So this is our worksheet. Make note of the fact that we've got this column that's the beginning of the period. We've got a column here at the end of the period. We've got columns in the middle for the debits and credits. This check formula is what makes the worksheet very handy. It's basically a T account. Okay, so it takes the it's basically the beginning plus the debits minus the credits equal the ending. It's explaining those changes, but it's written this way. It's the ending minus the beginning, and then minus the debit and plus the credit. And the formula stays the same all the way down my worksheet. And if you've opened the file, you've already got the formula in here. Do you notice I have all of my debit balances are positive and all the credit balances are negative? So I've only got one column for my debits and my credits, all in there together. All right, so the indirect method, from your readings and from what we've talked about and what we will talk about and what the great big picture video showed you, is the indirect method. The reason it's called the indirect method is because we're going to use our income statement in the operating activities section. We're going to use the fact that we've already got a summary of operating activities right here in net income. It is an accrual-based summary of operating activities. So what we're going to do with the indirect method, instead of showing explicitly where cash comes from and where cash goes, we're going to start with this net income number, and we're going to adjust it, just the non-cash items out of it, and use the changes in our operating accounts to come to a cash from operating activities. Okay, we say we arrive at it indirectly because we start with net income and then we basically just reconcile pieces to get to a cash-based operating number. So we can start this statement by looking at that income statement, and there's a tab. You have a tab for the income statement. And what I want to do is I just want to take a couple of minutes and have you mark the things. I'm not going to a couple of minutes, but just a second. Mark the items that do not involve cash and the items that are not operating. So if you look down the list, you can see the items that would never involve cash. Here's the first one, right? You know this from your accounting knowledge that bad debt expense doesn't involve cash. Looking down, you should immediately say, oh yeah, depreciation expense doesn't involve cash. Depreciation doesn't, amortization doesn't involve cash. Continuing down my income statement. Well, these things involve cash, but they are non-operating. Whoops. Okay, non-operating, meaning those are not related to operating activities. Those are going to be related to my investing activities. And then I have this unrealized holding loss on our short-term investments. If it was spelled out, you could see that. And that is a non-cash item. Okay, dividend, everything else could involve cash. So I'm going to stop there, but I've marked 1, 2, 3, 4, 5, 6, 7, 8 things that we are going to use to start our statement of cash flows. And by start, I mean we're going to start with our net income and adjust these items we just identified. We're going to remove them from this total. All right, and so that's what we're going to be doing from the income statement. So let's try to keep those where we can identify them quickly. On my statement of cash flows, the very first line, whoops, is going to be net income. And I'm just going to pick up this total from my income statement of net income. That is going to be my little reference A. Up above in this balance sheet worksheet, I'm going to find a credit to go with that. So when net income, what account does net income increase? It increases the retained earnings. So I'm going to put that whole 5,850 right there. It didn't wipe out the entire balance of retained earnings with my little T account math. We'll have to figure that out a little bit later. But it started us on our way. Okay, the next thing I'm going to do is just going to look back to that income statement and pull out those 8 items that we identified. Whoops. Okay, the first one I'm going to pull out, because this is just usually the way it works, is the depreciation ones. So I'm going to start with the depreciation on the building, and I'm going to pull that number out. Okay, now think about this. If this is an expense, depreciation on the building is an expense on my income statement. Remember, this is what I'm looking at here. It's an income statement. If this was an expense, that means it made my net income smaller. I'm trying to turn it back into a cash-based number. So that was a non-cash item that made it smaller. So I need to add that back in. So it's going to come back in here as a debit, which is an inflow, an increase to my cash position. So again, I'm just going to pull that number from the income statement. Let's shrink this a little bit so you can see more of it. And this is going to be my item B. And then I'm going to go up into the balance sheet and find a place that would also be the other side of that depreciation expense. And you know that would be right here. That would be the $17,500 in the building. Okay. I'm going to do the same thing with depreciation on the equipment. I'm just going to do this the easy way. Copy that down and put this in as something I need to add back. Depreciation on the equipment. I'm going to pull that number right off of my income statement. Okay, if I was doing this by hand, right, I could just be writing that number in. This is my item C. Up at the top, I want to make sure I'm keeping my debits and credits in balance, so I'm looking for the place where the other side of that depreciation expense would have gone, and that would have been $18,000 would have been credited to accumulated depreciation equipment. Now you see that didn't clean out the accumulated depreciation equipment, so there's something else that's going to hit that a little bit later. So we'll come back to that a little bit later. Right now we're just trying to deal with these 8 items we identified. Let's go ahead and pick up the amortization expense while we're in the neighborhood here. So I want to also add back amortization expense, again, because it's a non-cash expense, made my income lower, but didn't require cash. Okay, so now up in the balance sheet, I'm going to think about where would the other side of that amortization go? And since patent's my only intangible asset in this balance sheet, that must be where it was. Okay, so there's my amortization. So far, we've taken care of 3 of those non-cash items. Let's go back up and pull the bad debt expense, because we know that is also never going to involve cash. So there's my bad debt expense. It was the 300 here, I think. 300. That's going to be my item E. Up in the balance sheet, bad debt expense, the other side of that would have been to allowance for bad debt for 300. That didn't wipe out my allowance for bad debt, so I know there's something else that's going on. So we'll have to think about what else could have impacted the allowance for bad debt account. But for now, we're going to continue getting rid of these income statement items. We've gotten rid of those 4. The next one we can get rid of, let's go ahead and just work these in order. And so the gain on sale. Now this is actually a non-operating activity, so it's going to show up in a different part of our statement of cash flows. Okay, so that's why we're taking it out of here. Gain on the sale of land. Now this came into our statement of cash flows as a, came into the income statement as a credit. So we want to think about the fact that from a cash standpoint, or from this making back our income, we need to take it out. So it's going to come in here as a credit as well. So that is my gain on sale. While we're looking at the gain on sale, we should probably try and figure out what else happened with that. Because if I just put 8,000 here, I don't have an 8,000 debit. Or think about what happened with a gain on sale. That means we sold some land. Do we know how much land? Well, we don't unless we look at our general ledger detail. And let's see what we can find about selling land. So right here, this item number 5, we sold land with an original cost of $50,000 for $58,000. All right, so we're going to kind of jump ahead of ourselves, but this is the way. Whoops, that's not the right place. Go back, go back. Jump ahead of ourselves. So we have the 8,000 there. What I just said, we also sold, it was a sale of land. So there was 50,000. Now you could see in this, I've just debited or credited 58,000 with no debit. The debit would be down here in my investing activities section, which I'm going to leave myself a bunch of room. I might come back and delete some of that, but I want to have plenty of room. So this will be my proceeds from the sale of land. That just came from the general ledger detail notes that we had, and the fact that I know I need a $58,000 debit to offset those credits that I just made. Right? So here was a 8,000 credit, a 50,000 credit. I got to have a $58,000 debit to make that match. And that's my proceeds from the sale of the land. All right, moving right along. I've got to get rid of the rest of these things. Loss on sale of equipment. All right, a loss on sale of equipment. We're going to move that out as well, and we'll go ahead and deal with what that does to my statement. So a loss on the sale of equipment, that made my income smaller. It's not an operating activity, so I'm going to add that back. I'm going to pick this number up. It's in here as a negative, so I want it to be a positive. I don't want to have any negative numbers in my statement of cash flow worksheet. So I'm going to make sure it gets in the right column and the right sign. So there's my loss. on sale of equipment. Again, unless we look at the general ledger detail, we don't really know what that relates to. So looking in the general ledger detail, I see here item 7. We sold equipment for $1,000 cash, and it had an original cost of $5,000 and a remaining book value of $2,000. Basically gives it all the rest of the pieces that I need, except for just backing into one thing. So we sold it for $1,000. Had a cost of $5,000 and a book value of $2,000. All right, so we go back up to equipment. This was item G. We know we sold equipment with a cost of $5,000. It had a book value of $2,000. So now I know that means I got to get rid of the cost and the accumulated depreciation. To have a book value of $2,000, the accumulated depreciation wasn't $2,000. That tells me the accumulated depreciation was $3,000, because you remember from chapter 11, cost minus accumulated depreciation equals book value. Okay, so now I have this credit for $5,000. I have a debit for $3,000 for the accumulated depreciation. Here I have the loss on sale recognized. That's another debit of $1,000. But I got $1,000 in cash. So, whoops. Where did that go from? This was my proceeds from the sale of my equipment. Wasn't a lot of proceeds, but it is cash that came in. Okay, so that's going to take care of that piece. Back to my income statement. Remember, I'm still just trying to get rid of these 8 non-operating items. So I come back and I have a gain on sale of my short-term investments. So let me copy that piece over here. And again, this gain came in as a plus. We want to make sure it came in as a positive, but we need to take it out of that operating income number. So we're going to put it in here on the use side, or the outflow side, if you will. Okay, a gain on a sale, that means there was a sale. That means I need to go to the general ledger to see what happened with this sale. And this one is going to take a little bit more thinking. The purchase, we had purchased 3,000 shares for $10 a share. Didn't intend to, blah, 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 blah. I had at the end of the year, okay, that was all happened in 2012. Sold 1,000 shares for $14 a share. Okay, so 1,000 times 14 is going to give me 14,000 total. The cost of those 10,000 shares would have been, if those 1,000 shares would have been 10,000. That's how I got the $4,000 gain. Okay, so there's my pieces. All right, so we already looked at the $4,000. We got to remove the cost of that investment that was sold, or recognize the cost of it. It's already been taken out up here, right? So there's my cost. So that's going to explain all the difference in the investment. That change, I should say. So there's my $10,000 cost. There's the gain. I need the other side of that is going to be the cash I received from the sale. So that's going to be down here in the investing activities, 14,000. And this is proceeds from the sale of short-term investments. All right, you with me so far? We are almost finished with our items on the income statement. I've only got this one more thing, and that is the unrealized holding loss. This is neither a cash item or an operating item. Okay, so I have an unrealized holding loss. You remember from chapter 12. That is something we deal with our equity Passive equity securities. We recognize that unrealized holding loss on the income statement. That would have been the other side, would have been our fair value adjustment. Just to verify and make sure we're not leaving something out, we look in the general ledger detail. We'd see that those shares were trading indeed for $9 when they traded for $10 the year before. So they have dropped in value by $1, and we've sold 1,000 of them, so we only have 2,000. So 2,000 times $1 drop would give us the $2,000 that we see right here. Okay, so that takes care of that adjustment. So now we have taken care of all of the items that we identified as non-cash and non-operating. We are finished at this point with the income statement. So I'm going to just move it out of the way and just focus on what we have, the balance sheet and the general ledger notes, and that'll get us through the rest of this. So we're not finished with the operating activity section, so I'm going to keep going. What I want to do is I want to go up and look for changes in the operating accounts. Now that I've taken care of the things on the income statement, I want to identify all of my operating accounts, and I'm just going to note the change from the beginning to the end. This is the sweet, nice thing about the indirect approach. It's much faster once you get it set up and know what you're doing. So we'll take just a second and identify those operating activities. That would be our receivables. And we already said this was an investing activity, so not operating. Investing. We have inventory, that's a current asset. Prepaid rent, that's a current asset. Prepaid insurance, current asset. Office supplies, current asset. Okay, with our operating activities, generally speaking, it's our current assets and our current liabilities. Sometimes there's some odd things you will see, for instance, with your project. Not odd things, but there's other things that fall outside that general rule. But current assets and current liabilities, that's a pretty safe bet. So I've got accounts payable, taxes payable, and wages payable. Now I did tell you that short-term note, that would have been a financing activity, or if I didn't tell you, sorry, that was in a different video. That was going to be a financing activity. But now there's my operating activities. Okay, so I've identified each of those with an O, my operating activities. So what I need to do now in the operating section of the statement of cash flows is I just need to pick up the difference in those remaining operating activity accounts, right? So to get me started, I'm going to look at this, start at the top with accounts receivable. Okay, but before I jump in with accounts receivable, I got to recognize that, and I'm at J. This is going to be a little J. I need to deal with something in this allowance for bad debts, because we know it doesn't involve cash. So we need to figure out that $200. We talked about this being the other side of the bad debt expense entry. The other thing that happens with the allowance account is we have write-offs of accounts. So that must be what happened. And I say that because that's the only kind of activity that happens in that account. We record bad debts and we write off accounts. Okay, well, I guess we would also reestablish them if we got money, but you know what I'm saying. You got to think through all of those things. So here we have a write-off, and so the other side of the write-off would have made accounts receivable smaller. Okay, so we are looking now for the change in my accounts receivable. And I can tell by my little change formula over here, it's 4850. All right, so now I'm going to take that 4850. It's in the debit column. It's an increase in my asset. Everything that's an increase in my asset side is going to go on the outflow section. It's a decrease in my cash position. So there's my, this is my change in AR. Okay, that's my change in accounts receivable. All right, including that. There we go. So we've got those gone. Now we need a change in inventory. All right, this is where you're going to see how fast this actually is. Oh, I got a change of 7,000. This is item K. Increase in inventory means an outflow in my cash position. So there's 7,000 change in inventory. I'm going to go back up here and take out the next one. The next is a prepaid rent. It actually decreased. So it had a credit of 9,000. That is going to be an improvement in my cash position. Basically, that means I was using less of my cash for prepaid rent, holding on to more of my cash, if you want to think of it that way. I continue on with the same idea. If you get stuck, you can go back and look at this again later. Okay, so my item M is going to be increase in prepaid insurance. So prepaid increase means an outflow on my cash side. You can also think of it as it's whatever. If it was a debit, it goes down on the credit, if it's easier for you to think of it that way. This was my change in prepaid insurance. You could also label those increase or decrease, or just say change. Office supplies had an increase of $250. And that would be an outflow there. I'm going to have to add some lines. This is my change in office supplies. Give myself some more lines. Okay. I think I've taken care of the operating activities, or the operating activities in the asset side. We identified some things in the liability side, so let's take care of those as well. The accounts payable decreased from the beginning to the end. So this is going to be my item O. Now if the payables decrease, then cash decreased as well. 5,000. That was my change in accounts payable. Look in the increase in taxes payable there, so that's going to be my item P. 1,000. And an increase in a liability is actually an increase in my cash position. And then finally, I've got an increase in wages payable of 2,000. That is going to give me a change in wages payable that increases my cash position. So I'm going to put these in here and then I'm going to show you before I take a break here. That's my change in wages payable. It's an increase in my cash position because it was an increase in wages payable. So you could look from the top to the bottom and you'll see anytime that I have on the credit side here, it's showing up down here as a inflow. Anything that was on the debit side up the top is showing as an outflow. All right, so let's see what we have for operating activities. Whoops. All that remains is to add it up. See if it works. Okay, so I'm going to do this. Sum of all of the things on this side, all the way back up to my net income, minus sum of everything over here. It's just faster. 81,350, which is exactly the number I was hoping we would get. All right, just to keep this showing you how this is all working, if I sum up all of my debits, it should match the sum of all of my credits. And it does. All right, so we've done the operating activities section. I'm going to take a little break and then we will do the investing and financing activities sections.